there's no question that we understand systemic risk better than we did 10 years ago. And I think that's both from a academic, theoretical standpoint and a practical on-the-ground standpoint. And in part that's because it just was not a major area of study or a major area of interest for policymakers prior to 2007, the way that it is today. So we certainly understand it better. But like any other complex field, a lot of times the first wave of understanding something better is the recognition of all of the things that you don't know. Leaving aside policy uncertainty, which we would have, I think, for any change in administration, the United States is, I think, safer than it was certainly 10 years ago or 15 years ago, in part because we just had a crisis. And there's a certain immunity to having another one so rapidly thereafter, because a big part of what leads you to have a crisis is people's belief that it can't happen, and their willingness to pile on the risk at such very high levels because of a confidence that it can't happen. I don't think we have that problem at all here in the United States. We do, however, globally have some very large concerns. Europe has not yet emerged from the financial crisis, and there still remains tremendous uncertainty about the stability of their financial system, which has not repaired itself and did not go through the wrenching changes that we went through in the United States over the 2009-2010 period. And so there's still a lot of uncertainty there. China is, I think, somewhat of a mystery in that it's a very large, very fast growing economy now with a financial system that in many ways is not as well developed as the rest of the economy is. On balance, the DoddFrank Act of 2010 did make the country safer, and there are some specific aspects to it that I would be concerned if they went away. One thing is that the Federal Reserve was granted regulatory authority over a set of large non-bank financial institutions. Institutions like AIG, which when they nearly failed in 2008, there was no natural regulator. Their regulators were not systemic risk regulators, but rather state-level insurance regulators who didn't consider that part of their bailiwick. Same goes for institutions like Lehman Brothers, which were not regulated by the Federal Reserve. They were not their primary regulator. So right now the Federal Reserve has authority over these large non-bank financial institutions. That authority was granted by the DoddFrank Act. There's certainly been a lot of conversation about what aspects of the DoddFrank Act would continue. Some of them are much more important than others. This is an important aspect, and it would make me more nervous if all of a sudden there were large non-bank financial institutions that didn't have a very competent regulator like the Federal Reserve over them. A second thing is that Title II of the DoddFrank Act created a way to resolve, to take apart safely large financial institutions that failed, large non-bank financial institutions. Again, like Lehman Brothers, when they failed, it led to a very, very terrible negative cascade of bad events, and there really was no in-between. It was either bankruptcy or bailout, and that's all we had. The DoddFrank Act created an in-between, something called orderly liquidation.